Hey everyone, and welcome to another deep dive with us today.
Yeah, thanks for having me.
Today we are looking at a report from SOS Fin. Well, on the Mirae Asset Aggressive Hybrid Fund.
Mm.
So
hmm
that's a mouthful,
It is a mouthful.
but we're going to unpack it and figure out what's going on with this fund and whether it might be right for you.
Yeah, definitely. And at SOS Fin,
Hmm.
well, what we really try to do is make all of this financial stuff, investing and all that, make it as easy to understand as possible. So we try to break it down and make it really clear what's going on.
Awesome. So who is this particular report for?
So this one is really for anybody who's kind of thinking long term with their investments. They want to see their money grow over time, but they also want something that's maybe a little bit safer than just diving headfirst into the stock market.
Right, so they want to dip their toes in.
Exactly.
They don't want to just jump in the deep end.
Yeah, they want that potential for growth, but they also are maybe a little bit worried about the risk, and that's where this hybrid approach can be really appealing.
Okay, so speaking of hybrid, let's unpack this name a little bit. Mirae Asset Aggressive Hybrid Fund. What are we talking about here?
Right, so when we say hybrid, we're talking about a mix of different types of investments. So this fund combines equities, which are your stocks, with fixed income investments, and those are more like your bonds. And by blending those two together, it aims to provide that balance, right? You get some of that growth potential from the stocks, but then you also get a little bit of that stability and that downside protection from the bonds.
Okay, and what about the aggressive part? How aggressive are we talking?
So aggressive in this context really refers to the fund's asset allocation. It's allowed to invest a significant portion, we're talking 65 to 80%, in equities. So that means that they're really aiming for those higher returns, and historically equities have, provided that potential for growth over the long term.
Okay, so higher potential returns usually means
High risk.
higher risk. There it is.
Exactly, you got it. And that's where that hybrid element comes back in. By having that remaining portion invested in the debt securities, which are generally less volatile than stocks, it tries to cushion the blow a little bit if the market takes a dip.
Right, so you're not putting all your eggs in one basket.
Exactly, exactly.
Now, speaking of returns, I have to ask, the report mentions a 14% annual return over the past 5 years. I mean, I know past performance is not indicative of future results, but still 14%. That's pretty enticing.
Yeah, it definitely grabs your attention, right? But you're absolutely right to be cautious about past performance. That's why, we at SOS Fin will always encourage a deeper look. We want to understand the story behind the numbers. So, was that 14% return? Was that consistent year after year? Or were there wild swings? How did the fund perform when the market was doing great? How did it do when things got a little shaky?
So it's not just about looking at that one number, but understanding the journey that the fund has been on, right?
Yes, exactly.
Okay, and speaking of journeys, let's talk a little bit about risk because, as you said, higher potential return often comes with higher risk. And the report mentions the standard deviation of this fund is 14.5%. Now, for those of us who don't speak finance, what does that actually mean?
Yeah, it sounds very technical, right?
Very.
But it's actually pretty simple. Just think of standard deviation as a way to measure how much the returns of an investment might jump around. So a higher standard deviation means potentially a bumpier ride, and a lower one suggests things might be a little bit smoother.
So in this case, 14.5% standard deviation, where does that fall on the spectrum of bumpiness?
So I'd say it falls somewhere in the moderate range. It's not the wildest roller coaster out there, but it's also not, a leisurely stroll in the park.
So maybe a scenic bike ride with a few hills.
I like that.
Okay, so we've talked about standard deviation, but the report also delves into a couple of other metrics, the Sharpe ratio, which is 1.1 for this fund, and the alpha, which is 3.5%. Can you unpack those for us a little bit? What do those numbers actually tell us?
Sure. So the Sharpe ratio, think of it as a way to measure risk-adjusted returns. So basically, it tells you how much extra return you're getting for taking on each unit of risk. A Sharpe ratio above 1 is generally considered pretty good. So in this case, the fund is doing a decent job of balancing that risk and reward. And then you got the alpha. And alpha is essentially how much the fund outperformed its benchmark.
So it's like a measure of like how much better they did than just a basic, index fund or something like that.
Exactly. So a positive alpha means they're doing something right. They're beating the market, which is always a good sign.
Always a good sign. And speaking of doing things right, the report mentions that the fund manager for this fund is Mr. Nilesh Surana. What can you tell us about him?
Yeah, so Mr. Serrana, he's actually got a really impressive track record, especially when it comes to managing hybrid funds. He's been in the investment management world for over 18 years, so he's seen a lot of market ups and downs. He brings a lot of experience to the table.
So he's not a newbie. He's been around the block a few times.
Exactly, he's seen it all.
Okay, now let's talk a little bit about where the money actually goes. What's in this fund? What's the portfolio breakdown?
Sure, so the fund invests in a mix of sectors, which is good for diversification. And their top five sectors are financial services, technology, healthcare, consumer goods, and automobiles.
Okay, so it's pretty well diversified across different areas of the market. Any big names in there that people might recognize?
Yeah, absolutely. You've got HDFC Bank in financial services. There's Infosys in technology, Reliance Industries. So these are companies that a lot of people are familiar with.
So it's kind of cool. You get to own a tiny piece of some of these really big companies.
Exactly.
All right, so we're owning a tiny piece, but then we've got to pay fees, right? Because nobody likes hidden costs. So the report mentions an expense ratio of 1.5%. What does that mean? Break that down for us.
Yeah, so the expense ratio is basically a small annual fee that you pay to cover the fund's operating costs. So that includes things like administrative expenses, management fees, things like that. And in this case, 1.5% of your investment would go towards these expenses each year.
1.5% doesn't sound like a lot, but I imagine over time that can really add up, right?
Yeah, absolutely. It seems small, but over the long term, even small differences in these fees can make a big difference in your overall returns.
Right, so it's definitely something to pay attention to, even if it seems like a tiny percentage.
Absolutely.
Okay, now what about flexibility? Let's say I invest in this fund, and then I suddenly need to access my money. Are there any penalties for early withdrawal?
That's a great question. And, some investments do have lock-in periods where you can't touch your money for a certain amount of time. But with this particular fund, there's no lock-in period. So you have the flexibility to withdraw your investment whenever you want.
Oh, okay, so that's good to know. You're not stuck.
Exactly.
So we've talked about flexibility, but what about taxes? Because, of course, nobody likes a surprise tax bill come tax season.
No, nobody likes that. So this fund, it's considered an equity-oriented fund. Remember how we were talking about how it invests over 65% in stocks? So any gains that you make from this fund would be subject to long-term capital gains tax, or LTCG.
Okay, so LTCG, what does that mean in plain English?
Okay, so basically, if you hold your investment for more than 1 year and then you decide to sell it, any profit that you make is considered a long-term capital gain, and the good news is that you get some tax benefits. So gains of up to 1 lakh in a financial year are completely tax-free.
Oh, wow. Okay, so you can actually make a decent profit without having to pay any taxes on it.
Exactly. And even if your gains exceed that 1 lakh limit, the tax rate is still pretty reasonable. It's just 10% on the amount that exceeds that limit.
Okay, so that's good to know. Taxes can be confusing, so it's nice to have that clarified. Now, one more term before we move on. The report mentions AUM, which stands for Assets Under Management. What is that all about?
Yeah, so AUM, that's basically the total market value of all the assets that the fund manages for all of its investors. So it's kind of like a measure of the fund's size and popularity.
Okay, so a larger AUM generally means more people have put their money into this fund. So it's kind of like a vote of confidence from the investment community.
Exactly. It can be seen as a sign that investors trust the fund's strategy. They trust the management.
Okay, so we've covered a lot of ground here. We've talked about the fund's objectives, the potential for growth, how risky it is, what kind of returns you might expect, even touched on taxes. But the big question still remains, is this the right fund for you?
That's the million-dollar question, right? And the truth is, there is no right answer for everybody. It depends on your own personal circumstances, your financial goals, your risk tolerance. It's all about finding the right fit for you.
So how do we figure that out? How does someone listening to this decide if this fund is the right fit for their portfolio?
Well, there are a few key things to consider, and we'll dive into those right after the break.
So how do we figure that out? How does someone listening to this decide if this fund is the right fit for their portfolio?
Well, there are a few key things to consider, and we'll dive into those right after the break.
So we're back and ready to figure out if the Mirae Asset Aggressive Hybrid Fund belongs in your portfolio.
Right, because as we were saying, it's not a one-size-fits-all kind of thing.
Not at all. So let's break it down. Who would this fund be a good fit for? What kind of investor are we talking about?
Okay, so based on everything we've talked about so far, I think this fund could be a really good fit for someone who's really looking at that long-term growth. They want to see their capital appreciate over time. They're not trying to, make a quick buck.
They're not day trading.
Exactly. This is more about, planting a seed and letting it grow, steadily over time.
Okay, so patience is key with this one.
Absolutely. This is for those long game players.
Got it. What else? What other things should people think about when they're considering this fund?
I think risk tolerance is huge, right? Because this fund, it leans towards the aggressive side. That's what's in the name, right?
Right.
So there will be some volatility, there will be some ups and downs, and you have to be comfortable riding those waves.
Because if you're the type of person who's checking their portfolio every 5 minutes and panicking when it dips a little,
This is probably not the fund for you.
yeah, you're going to have a heart attack. It's not going to be fun.
Exactly. And again, there's nothing wrong with being risk averse. It just depends on your personality and what you can handle.
Right. And if you're unsure about your risk tolerance,
Talk to a financial advisor seriously. They can help you figure that out.
they can walk you through it. That's their jam.
Exactly. That's what they do. So we've got long-term mindset. We've got being okay with some risk. What else should we be thinking about?
Yeah. What other boxes do we need to check?
Investment horizon. That's another big one. How long are you planning to keep your money invested?
Because that will impact how much risk you're willing to take on.
Right, exactly. The longer you're invested, the more time you have to recover from any short-term dips in the market. And remember, this fund, because it leans toward equities, it has the potential for higher returns over the long haul.
But it needs time to work its magic.
Exactly. So if you're saving for something like retirement, 20, 30 years down the line, this could be a great option.
Probably not if you're saving for a down payment on a house next year.
No, probably not. You'd want something a little more stable, a little more predictable in that case.
Right. Short-term goals, different strategy.
Exactly. Gotta match your investments to your goals and your timeline.
Now, one thing that I thought was interesting in this report was it actually suggested this fund could be a good starting point for new investors.
Interesting.
Which at first I was like, really? Because, for someone who's just starting out, it can feel so overwhelming. There are so many options.
Oh, absolutely. It's information overload.
It's like, where do I even begin?
Exactly. You're bombarded with all these terms and these strategies.
So why do you think they landed on this particular fund as a good potential starting point?
Well, I think it goes back to that balance,
That balance between risk and reward.
Yeah, it gives you exposure to the stock market, which is where a lot of the growth potential is, but it's not like throwing you in the deep end. It's got those bonds in there to kind of, soften the blow a little bit.
Right, so you're not going all in on stocks right away.
Exactly. It's like dipping your toes in the water, getting a feel for things before you decide if you want to go all the way.
I like it. And plus, there's that diversification.
Oh, yeah, huge. That's built-in risk management right there.
Because you're not just betting on one company or even one sector, you're spread across a whole bunch of different things.
And that can make for a smoother ride, especially when you're first getting started.
Makes sense. Now, we've talked about who this fund might be good for, but what about the flip side? Who might it not be suitable for? Who should maybe steer clear?
Yeah, it's just as important to know who to avoid, right? And I'd say if capital preservation is your absolute top priority, if you can't stomach the thought of any fluctuations in your investments, then this might not be the best fit.
So someone who's closer to retirement, for example, they might need something a little more conservative.
Exactly. Because at that stage in life, you're not necessarily looking for high growth. You're more focused on protecting what you've already built.
Right, preserving that nest egg.
Exactly. And again, this is all general advice. It's always best to talk to a qualified professional, a financial advisor. They can help you create a plan that's tailored to your specific situation.
100%. They can help you figure out if this particular fund is right for you or if there's a better option out there.
That's right. And on that note, one thing that I think is super important to remember is that this is all just information, right?
Right.
We're giving you the lay of the land, but at the end of the day, you have to make the decision that's best for you and your financial goals.
It's your money, your future.
Exactly. So do your own research, consider your options, and don't be afraid to ask questions.
Absolutely. Knowledge is power, especially when it comes to your finances. Now, before we jump into the next part, let's recap some of the key takeaways about this fund.
Yeah, sounds good.
So we've talked about who this fund might be a good fit for, but what about the flip side? Who might it not be suitable for? Who should maybe steer clear?
Yeah, it's just as important to know who to avoid, right? And I'd say if capital preservation is your absolute top priority, if you can't stomach the thought of any fluctuations in your investments, then this might not be the best fit.
So someone who's closer to retirement, for example, they might need something a little more conservative.
Exactly. Because at that stage in life, you're not necessarily looking for high growth. You're more focused on protecting what you've already built.
Right, preserving that nest egg.
Exactly. And again, this is all general advice. It's always best to talk to a qualified professional, a financial advisor. They can help you create a plan that's tailored to your specific situation.
100%. They can help you figure out if this particular fund is right for you or if there's a better option out there.
That's right. And on that note, one thing that I think is super important to remember is that this is all just information, right? We're giving you the lay of the land, but at the end of the day, you have to make the decision that's best for you and your financial goals.
It's your money, your future.
Exactly. So do your own research, consider your options, and don't be afraid to ask questions.
Absolutely. Knowledge is power, especially when it comes to your finances. Now, before we wrap up our deep dive into the Mirae Asset Aggressive Hybrid Fund, let's take a moment to reiterate. Everything we've discussed today is for informational purposes only.
We're not giving financial advice here, right? This is just a starting point.
Exactly. For our listeners who are intrigued by this fund and want to learn more, who should they reach out to?
Definitely check out SOS Fin. Well, they're the ones who put this report together, and they can give you all the details.
Awesome. And with that, we've reached the end of our deep dive. A huge thank you to SOS Finwell for all the insights, and to you, our amazing listeners, for joining us. We'll catch you next time for another deep dive into the world of finance.